All right, we're back for another episode of the REMO show. We've had a rate cut, and now we're all wondering what's next, and that's what we're going to jump into today. It's been a little bit of a hiatus here for us. We got myself, Tyler, and Derek back on the show. We took a break for a good reason. Maybe Tyler, you can shed some light on that.
Yeah, I've been stuck in baby jail. My wife and I had our second child in April, a little baby boy. Yeah, we all share an office here, and this is literally the second time I've set foot in this office since this kid's been born. I've been working remotely, basically, so life's getting a little bit back to normal, so we're going to hopefully get back to a pretty consistent schedule. That's the plan, and at least we're coming at you with some exciting good news sort of topic versus the last, 2 years of kind of nothing but bad news when it comes to rates.
Yeah, you got some gray hairs too. I
Yeah, definitely. Yeah.
When's the third kid coming?
Never. Yeah, I'm going to try and get a group discount to Dr. Pollock.
It's been some time since the rate cut, but there's certainly been a lot of movement, a lot of changes, a lot of things going on, especially with the stats and the reports coming out of the U.S. and Canada in regards to our economy, job reports, all sorts of ups and downs, and a lot of the same from a perspective of hard to predict. But we're starting to see some normalcy. We are starting to see some predictions come through, and we are, what it seems to be on the downward trend with rates, and there's a lot to be excited about for that. Like it's kind of a weird thing to cheer for bad news in the economy, but bad news means good news for mortgage rates, and that's kind of what we're starting to see, just a trend of bad news that's going to fuel some good news for the mortgage side. So yeah, why don't we just jump right in? Derek, why don't you kind of take it?
Yeah, so as I'm sure every single person on planet Earth knows, Bank of Canada dropped rates by 0.25% in June. The impact of that we'll touch on in more detail, but probably not as great as one would think. But like Dean mentioned, any good news is what we're hoping for, given what we've all been through in the last couple of years here. So Bank of Canada, again, dropping rates. So that immediately impacts variable and then line of credit products. So bank prime rate right now is 6.95, which came down from 7.2, which equates to about $15 for every 100,000 of financing that someone holds. In today's market, this is a little bit gray because there's insured and there's conventional, but if someone was going into a variable mortgage as of today, you're in the really high fives to low to mid sixes, in and around that range for a 5-year variable. Comparing that to fixed rates, I mean, I'd say 95% of people are jumping into a 3-year fixed, which we can touch on the why behind that. Generally, a 3-year fixed as of today, you're looking in the really low fives. So it's significant. Like in most situations, it's more than 1% below. So as much as these variable rates have come down a bit for people getting into the market, a new mortgage, a new refinance, a new purchase, we're not seeing a whole lot of people opt for that variable mortgage as of now. I would suspect that over the next few months, with a couple more Bank of Canada cuts, hopefully, we'll start to see people starting to opt for that variable because the gap is closing pretty significantly. And the consensus is that Bank of Canada will continue to drop until we kind of find a happy medium here. And you would think at that point, it should be landing in and around the fixed rates that we're seeing right now.
These meetings don't happen at random, right? They're scheduled, I think in December for the next following year. And so what's remaining for the rest of 2024 is 4 meetings. There's one in July, sort of towards the end of July, September, October, and December. How many are we going to see? A lot of that remains to be seen. The best thing we can follow is just sort of probabilities and everything that we read. And right now it's looking like the July rate cut is a little better than like a coin flip that we will see a rate cut. And then towards the end of the year, I don't watch the Bank of Canada meetings, but certainly read a bunch afterwards. And they just keep hammering on. They're going to be data dependent, and everything is sort of looking a month behind, right? So we had May inflation report that came out this month that was actually a lot higher than they expected, which kind of killed some of the odds of maybe we're going to see a rate hike. But then some jobs data came out a few days later that showed that the economy is actually slowing and unemployment is rising, which is what they want to see. So Dean mentioned it's weird to kind of hope for bad news, but the kind of dark part of this all is you need some people to lose jobs, hopefully not everybody. And so they're really trying to thread the needle here in terms of bringing interest rates down at a reasonable rate so they don't reignite inflation. But as it looks right now, like July, probably looks a little bit better than a coin flip. Like I said, that we'll see a cut. So that would mean that we're down 0.5% from the peaks that we had, that we've been living through. Where do we go from here? What are the predictions saying? There's always articles coming out where all the top major bank economists, and when I say major bank, we're talking TD, Scotia, RBC, CIBC, BMO, the big five that you know and see around town. And their kind of head honchos are all saying we'll see something, their consensus view is, 75 basis points of cuts for the year. So we've seen one. So maybe that means we'll see another 0.5% before the end of 2024, which would be welcome news. It would be really great news for anybody sitting in a variable rate, and it'll help ignite sentiment, you would think, in the housing market, which has been a bit sluggish still. So we'll see what happens. Like I say, once we start to get these inflation reports continuing to come out, that'll sort of guide us as to what's coming. But I don't know. I guess if I was betting, I would think July is probably looking like a cut.
I would agree with that. And I mean, just hot off the press right now, the employment numbers for June were awful for Canada. Canada lost 1,400 jobs in June. That's the highest since January 2022. Full-time jobs fell by 3,400 and were replaced by part-time jobs of just 1,900. So pretty significant numbers. Like that is some real bad news from an economy perspective. But that type of a report would definitely, make the economists probably hopefully understand that it's not as resilient as maybe they thought, right? So
especially when you consider, I know we don't dive too much into the macro, but like the amount of immigration that has poured into this country in the last 2 or 3 years. Like I've read this same take multiple times that like the economy theoretically should be adding something like 30 to 50,000 jobs a month with the amount of people that we're letting in, and now we're not adding any jobs. In fact, losing jobs. And these numbers are so funky. Like the more and more I read and pay attention to this stuff over the last few years, like if you read the jobs numbers, like sometimes they'll come out and they might surprise you, and then the following month they get revised, and they pretty much always get revised down like worse, right?
Oh, yeah. So, which you could say that from almost all these reports that we're now keeping an eye on, which they're almost always coming out with revisions, and they're typically in the worst direction, right? Well, why don't we jump into qualifying impact? Like, how is this going to impact borrowers as we start to see, first and foremost, the current drop? Does that have any impact, and what can we expect as we start to see rates come down?
There's a big misconception around this too, right? Like a lot of people think when Bank of Canada comes down, that fixed rates are going to come down. Like I mentioned earlier, Bank of Canada only directly impacts variable and then line of credit products. So, that 0.25% decrease that we saw, again, this isn't a guess, but, let's say 95% of new borrowers, people buying, refinancing, what have you, are not opting for a variable in today's market because of the gap in interest rates. So that cut only impacting variable rates really doesn't impact the bulk of the market because people are opting into fixed rates, and fixed rates haven't necessarily changed because of the Bank of Canada cut. Don't get me wrong, fixed rates have come down significantly over the course of the last year and a bit. We were at a high of, I think, 6.8% for a 3-year fix. And like I said, now, we're seeing these at 5.09, 5.04, in and around that range. So they have come down, but not directly because of the Bank of Canada cut. So based on that June cut, for the people going fixed, there's no positive impact to your qualification. There's no change to payments. But for the handful of people that are opting into a variable mortgage for specific reasons, and there is reasons and rationale to do that right now, depending on your situation, it's a very minimal increase, of about 3%. An example that was put together here is $600,000 qualification. After that cut would probably get you to about $620,000, right? So about a $20,000 difference on a $600,000 purchase. So again, positive, not overly positive. A lot of times, depending on the lender and your situation, you can get an exception in and around that range anyways, right? So again, like the cost per month, there is some benefit there, about $15 for every 100,000 that you have mortgaged. And we'll continue to see that as Bank of Canada continues to drop rates, right? But from a qualification perspective, not a lot of relief for the majority of the market.
No, and like it's kind of, unless you're in the business or you've been through a few mortgages and you really got a handle, it's kind of hard to wrap your head around it. But like very basically, variable rates are higher, so you qualify for less. So in that example, if you were pre-approved, you want to take a variable, you were looking at a $600K max purchase, and now it's $620, like you would be qualifying for quite a bit more going fixed anyways, right? So yeah, so it
Which I think is very important to point out, and maybe that just segues well into the impact from a fixed rate perspective. And there's a few things we can touch on, but clearly, like it's pretty minimal based on what's occurred here. One thing I wanted to point out was just as we start to see rates go down, especially on the fixed side, we're already starting to see banks drop the posted rate, and that's important because it impacts the IRD penalty. So as if you're in a fixed rate mortgage and you're considering potentially selling or breaking that mortgage, there is a play to potentially do that sooner than later, given what's going to happen with these IRD penalties. And what I mean by that is when you pay out a mortgage, typically with a big five bank, they have a different way of calculating those penalties. And if that bench rate or if that posted rate is coming down, that's going to impact the penalty, and the penalty is going to get larger as rates come down and the posted rate comes down. So I just wanted to touch on that, something that could be very impactful depending on when you're going to sell and ultimately what that penalty can look like. And it's very, very hard to time that. And you are kind of at the mercy of the lender, but sooner the better from that perspective if you are considering breaking.
And that's kind of part of the reason Derek mentioned earlier that most people are going with a 3-year fixed rate, right? It kind of lessens the risk and penalty and then opens you for renewal sooner, right? The big five bank 5-year fixed is like the killer in terms of penalties, right? The number is usually around 4 to 5% of the balance outstanding if you break that penalty in the middle of your term, which if you've taken a 5-year the last year or two and rates maybe cycle down a lot over the last 18 months. I mean, rates are always such a personal finance decision, but that penalty could be nasty if rates and these posted rates continue to slide down.
I think that's a really important piece to touch on because, especially the way that the market's gone the last 2 years, everyone's always been focused on rate, but not as much when you're comparing a 2.1 to a 2.3. It's a very competitive rate. As rates have gone up, everyone talks about rate. Everyone's more focused on payment and cost. But really, if you want the lowest rate possible, you're probably taking a 5-year fixed, right? But you're not really thinking about the impact of, well, what about when I fast forward a year and a half and rates have come down, hopefully significantly, and you go to look to refinance? We saw a lot of this through COVID of people that were locked into 4 or 5-year fixed terms. Rates came down, they want to refinance. We get a quote on the penalty and it's $25,000, $30,000, $35,000, $40,000, and you can't, right? So you're basically stuck in that product. I mean, there are certain situations where it still makes sense and you could potentially recoup that cost, but it's a tough thing to justify and to stomach taking that on because you don't know. You might end up selling the property or doing something, earlier in that term anyways.
Yeah, I mean, you briefly discussed just how fixed rates do move independently from variable rates, given the cut that we just saw. You want to maybe touch on that a little bit deeper, just in regards to what we can expect from fixed rates and when and how we can expect them to hopefully come down.
Variable rates, it's very linear, right? Like you're going to move up and down specifically because the Bank of Canada is changing the interest rate and it's predictable. It's 0.25% at a time. Like when you hear the Bank of Canada drop rates by 0.25%, every variable rate will eventually drop by 0.25%. Fixed rates move on something different. They move on bond yields, and bond yields is a much more fluid kind of measure, if you will. And that's it. Just think of it kind of like the stock market, right? People are buying and selling bonds with the expectation of where interest rates are going to go. And obviously Bank of Canada, their meetings are scheduled out 6 weeks at a time, essentially. But, if there's a cut and then there's a whole bunch of new economic news that comes out immediately after that the economy is slowing, generally bonds will fall and fixed rate mortgage pricing will go down. So while they move independently, they generally move in the same direction, right? And so that's why we're seeing fixed rates and variable rates so different, like almost a full percent, because the expectation is that rates will continue to fall. So fixed rates are kind of front running the Bank of Canada in a way. And I know we've already hammered this point home, but because of the gap is so large, that's why people are still opting for fixed, right? If you think about it logically, if you're getting a fixed rate that is 1% or even 1.25% cheaper than a variable rate, that's 4 more cuts, right? We need 4 more Bank of Canada cuts before that variable rate that you would have taken would match the fixed rate that you did take. And even then you're not celebrating, right? Rates need to come down another 3 or 4 times before you would ever win out, because all the while it took to get those initial 4 cuts, you're paying more in interest, right? So that's why we're seeing the majority of people still steer towards a fixed rate.
Yeah, and just a little bit more lay of the land. Like you would think maybe a 1-year fixed or a 2-year fixed would make more sense, knowing that rates are probably actively coming down, and that would make sense. But once you look at the interest rate tied to a 1-year, like a lot of banks are at 7%, right? So no one's taking that. Average on a 2-year is in and around 6, a little bit higher. There's some one-off situations where there's some promotions for 2-year fixed terms, but for the most part, you're looking at 6, right? So in all these scenarios, and plus for most borrowers, like it is expensive even at 5.09 or 4.99, like it is costly. So getting into that mortgage right away with a lower payment, and we touched on qualification. A lot of people need to go with that lower rate just to get the house that they want, right? Or get the refinance done that they need to achieve. And even if a 1-year might have made way more sense for your situation, you probably don't qualify for it in most situations because of the rate and the inflated payment.
Moving on and looking to kind of round out the episode here, let's just touch on some market reaction to this first cut. There's a few things, a few pieces of data that we've kind of accumulated just internally that we can touch on. And then we'll look to wrap up just kind of with the fixed versus variable and do a bit of a roundtable on the demographics of buyers that we would suggest, considering both of those products. So just jumping into market reaction, I'll kind of start off from the first cut. We definitely saw an immediate response in leads. So essentially what we would consider a lead is just simply people inquiring about financing and looking to do something such as buy a home, refinance. Those sorts of things start to become a lot more top of mind in as soon as we see a rate cut, people start to move, and there's definitely been a little bit of getting off the fence type mentality in a sense. But so yes, we saw an immediate response to leads, but are those like super active, super ready to go? No, maybe not so much yet because it's just the one cut. But it's been interesting to say the least that we saw that little bump.
Yeah, it definitely drove a lot more conversations. I know at our business Thrive, like we definitely saw an immediate response in leads. But I mean, if you just look at the data, overall sales activity, like it's sales activity is actually kind of fallen, right? So it hasn't been like a real game changer in the marketplace, but the real estate market's much like a stock market. It can often be hive mind, right? Like, so often people end up chasing the market once they hear more and more people are getting into the market. So I can certainly see a scenario where if we see another cut in July, who knows, maybe one in September, October, suddenly everyone who was waiting, like, okay, yeah, now let's go, and maybe we get a bit of a run again, right? So I'd say overall reaction's been pretty muted. And also it's this time of year too. Like if we look at how 2024 has gone, like we almost had a mini spring market in January, sort of December, January, February. And in my mind, that was completely driven by central banks in Canada and the States saying, we're going to cut rates this year. And everyone thought we were going to see immediate rate cuts, lots of rate cuts. And we had a flood of inquiries, tons of leads coming in. And what typically the busy spring market kind of happened early. And then as data came out through February, March, April, where it looked like, okay, maybe we jumped the gun thinking rate cuts would happen right away. To me anyways, it felt like the life kind of got sucked out of the market. And now we're in a position where the data is supporting rate cuts. And this time of year, like we're recording this in July, it's usually going to slow down anyways. Kids are out of school. People don't want to move. So purchase activity generally kind of dwindles a little bit. So it's kind of hard to pin down whether or not that had much of an impact because real estate, we're probably getting into more of a seasonal type marketplace again. So it's hard to say. I mean, I think if we see one more cut, that'll give us a better idea if things are going to start to turn.
I mean, on the cuts, if everything that we think will actually come to fruition, if the Bank of Canada continues to drop, who knows, 5, 6, 7 times over the course of, call it 2 years, like once rates actually get down a bit to a point where people are comfortable and they're opting into that product, like every single time the Bank of Canada cuts, we should get a little bit more push behind the market. Like we should have a pretty steady, strong uptick here over the next, 12 to 24 months, I would imagine, outside of the typical summer markets and whatnot that do just simply slow down, right? Like not a lot of people want to move when they have their kids at home. And then just something else that I think we're seeing a lot more of now because things have kind of slowed down a bit is there's a lot of people that are trying to sell and buy in the same market, right? And that's where like a first-time buyer might opt to not purchase because, you know, they're waiting for rates to come down or whatnot. We all know that there's never really a perfect time for that. But if you're selling and buying in the same market, it doesn't really matter what the market's doing. But a lot of people will find the home they want to buy, they list their home, and there's not enough activity. So that deal ends up falling apart, whether it be 2 weeks or 2 months later, depending if you're dealing with subject to sale. And I know there's a lot of people kind of in that dilemma right now.
Yeah, well said. And I think like just going into a market like a downward trend rate market, given the fact that we're in a going back to the bad news from the economy perspective, looking at this job reports, at the end of the day, sometimes it just comes down to affordability. Like regardless of the rates going down, we could see, like to Derek's point, let's say 6 cuts in a matter of the next 2 years or whatever it is. If people just can't afford homes because there's a lack of jobs and there's just a lack of affordability in our market, like that's we shouldn't just expect a boom. Like I think a lot of folks look at this from the outside and say, hey, rates are coming down, we're probably gonna have another boom in market. Like that might not be the case. Like when we came out of a low rate climate, we didn't have as bad of an economy that we may have going forward. So like there's always like some balance there to consider. Okay, so why don't we just jump into like fixed versus variable for buyers and just kind of consider like, looking at a first-time home buyer as an example, what would you recommend? And of course it's buyer dependent and comfort in financing and everything else, but let's just kind of riff on this for a little bit.
Yeah, I mean, first time, like, I guess we probably won't want to just differentiate between insured and uninsured. Just it gets a little bit too technical, but first time buyer, with the gap still 4 to 5 rate cuts, to me, it seems like a fix still makes the most sense. But we certainly help, obviously depending on your personal situation. Like if you look at the variable rate quote, you can qualify for the place that you want. The payments are okay for you. It's not going to impact your lifestyle. Those are the people that, are well suited to take a variable, because one thing a lot of clients that I have helped variable are doing is like, okay, it looks like we're going to see more rate cuts. We've learned that fixed rates generally follow the same direction as variable rates, maybe not as quickly, and maybe it's still a bit of a dice roll. Just because you start variable doesn't mean you need to finish variable, right? You could take a variable, see if we get a couple cuts, and then lock in, and maybe you got yourself a cheaper fixed rate. So, yeah, to me, like laying out all those options, yeah, I agree with Derek. 95% of my clients still going for fixed.
Yeah, and I'm racking my brain right now. I can't even really think of a scenario where a variable would make a lot of sense. Like even, an investor, an upsizer, if you're doing like multi-generational, historically when rates were lower, if someone says, well, look, I'm going to sell this house in 6 months, and you would go variable because the penalty was low, like these 3-month interest penalties are significant now because rates are high and interest costs is through the roof. Like you could easily see a $10,000, $15,000 penalty to pay out a variable mortgage. So like in that scenario, it probably makes more sense to bite the bullet on interest and go line of credit if you can for most of it. I think some people are just bought into variable. It's done them very well for 20 years, and they're just comfortable with it. They understand it. They know that they've saved money over a long period of time, and this has been a bit of a bite in the ass. But in that situation, a lot of people, like if you've gambled this long essentially and you've ridden it out this long, some people might just mentally want to stick with it and see the benefits, and all you're really doing is hoping and praying that the Bank of Canada comes down as quickly as possible to make that make sense financially.
Yeah, I mean, at the end of the day, like we're essentially generalizing this for everyone, all demographics. It doesn't really matter. Like the advice is pretty much the same at the end of the day when it comes to comparing these products. And I think just some of the things we touched on this episode might just push you towards fixed anyways, such as qualification and just affordability in general, because of the spread being so big right now. So like at some point, folks just have to think about the here and now. What does it cost me now? Can I actually qualify now? I need to pull the trigger now for whatever reason. And you're kind of falling in a fixed rate mortgage for all those reasons that we talked about today. So,
and if you're really on the fence and you can't make a decision, there are certain lenders, there's only a select few, but you could opt to do a portion of your mortgage in a fixed. You could do a portion of a mortgage in a 2-year fixed, a portion in a 3, a portion in a variable line of credit. So like if you really want to get convoluted and you want to try to, balance this out as best you can, certain lenders will allow you to break your mortgage into certain, some of them allow up to 5 different components with different rates and products in that.
All right. So to just kind of round this out and wrap up the show, is it time to lock in? let's say we're talking to somebody like Derek mentioned that's been riding out the variable, sticking in their mortgage. Maybe they're coming up for renewal, or maybe they're just considering locking in. What would be your advice?
Depends on the product. If it's like a fixed payment variable, chances are locking in and you haven't increased your payments. If rates have moved up, chances are you're not going to get any payment relief. So if you're looking for payment relief, it depends on the product you're in. If you're in a true adjustable variable, you should get immediate payment relief, right? If you're maxed out, locking in could save you a decent chunk, right? If you're sitting in a fixed payment variable, which is basically every single major bank except for Scotiabank, and you're looking for payment relief and you haven't been increasing your payments or only did a couple times when rates were rising, then locking into a fixed, you just need to have them quote the rate and the payment, not just get the rate that they'll lock in. Look at the payment before you pull the trigger, because that'll give you the info you need.
I think you also need to know what term they're going to be locking you into on a fix. There are certain lenders that even if you're one day into a 5-year variable, they will give you the option to convert into a 3-year fix. Most lenders don't operate like that. And if you're in the first year of a 5-year variable, they're going to lock you into a 5-year fixed, which again, like we talked about, may or may not make the most sense with the way that the market's going. And it really depends on what your interest rate is, right? If you have a prime minus 2, which was absolutely a thing at one point, you're sitting at 6.75%. And if you can convert that into a 3-year at 5.09, that's significant, right? But if you're sitting in a variable at 5.9, the gap's a lot smaller and you might just opt to ride it out, right? That's 3 more rate cuts before you're kind of breaking even.
Yeah, well said. I don't really have anything more to add to that, and we'll wrap it up there. It's good to be back. It's a good episode. There's a lot of good stuff there, and we'll look forward to doing this again very soon. And for anyone that enjoys the show or appreciates what we're doing, please give us a 5-star review if we earned it, and leave us a review, and give us any sort of suggestions you can on content going forward. We're happy to hear it and implement it. So thank you for listening.